getting a discount should be, simple math, right?
Oh, absolutely. It feels like it's
Yeah,
simple.
you see a price, you subtract a percentage, and you're done. But in business, offering a discount before a customer even pays can completely warp your profit margins if you guess their behavior
Oh,
wrong.
big time. It's a huge risk.
Right. And whether you're a 23-year-old student prepping on your commute or a 38-year-old professional analyzing a company's books on your lunch break, this exact uncertainty is your problem. But there is a very specific 5-step rule that solves this guessing game. And missing it is literally the #1 reason people fail this topic.
It really is the ultimate trap for anyone who relies on instinct instead of the actual standard.
Welcome to the deep dive. Today we are covering financial accounting, specifically IFRS 15 and how it handles prompt payment discounts. We will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
Sounds like a solid plan. To start with the simplest possible definition, a prompt payment discount, which you might also see called a settlement discount or a cash discount, is just a price reduction offered to credit customers purely to encourage them to pay their account quickly.
Okay, so think of it like a local coffee shop that offers a 50-cent discount if you bring your own reusable cup.
Yeah, that's a perfect analogy.
You, as the business owner, put that incentive out there. You want them to bring the cup, but you don't actually know if they're going to bring it until they literally show up at the register. So how do you predict your revenue for the day when the final price is, well, entirely up in the air?
Exactly. And here's the surprising fact about that. At the exact moment of a sale, the actual amount of money the business will make is technically not guaranteed.
Wait, really? Not guaranteed at all?
Nope. It is entirely dependent on the customer's future choice within a specific settlement window. You've made the sale, the goods have traded hands, but your final revenue number is literally still pending.
It's a bit unsettling when you really think about it. Basically, it's a financial incentive for speed that turns a fixed invoice price into a variable one.
Right.
The price tag on the transaction isn't locked in, it's actively tied to a ticking clock.
Yeah, and for those of you making management decisions or, auditing those decisions, this isn't just abstract accounting theory. Handling these discounts requires a significant element of judgment.
And that judgment has consequences.
Huge consequences. It directly impacts a company's gross profit margins. If you're a business operating on thin margins, you have to estimate how much revenue to recognize initially, and you must have actual tangible evidence to support those estimates.
So you can't just cross your fingers and hope.
No, you really cannot cross your fingers, assume everyone will take the discount, and book the numbers based on hope.
Which brings us to the exams. There are 2 reasons examiners love this. Here's the first. It directly tests your ability to handle variable consideration under the rules of IFRS 15.
Right, and the second reason is that it tests the concept of significant revenue reversal. It reveals whether you actually know how to limit uncertainty when you're recording sales.
Limiting uncertainty.
Because historically, before these strict rules were in place, companies could engage in what we call earnings management.
Making the books look better than they are.
Exactly. A company might want to look incredibly profitable for a third-quarter earnings report, so they'd book massive sales at full price, knowing full well that customers were going to take discounts later.
Wow, so they inflate their revenue on day 1.
Yeah, they look great to investors and then quietly adjust the numbers down in the next quarter. IFRS 15 was designed specifically to stop that exact behavior.
But I have to ask, isn't it dangerous for an accountant to just guess how much money is coming in based on a discount?
Right.
If we're talking about protecting profit margins and preventing inflated numbers, guessing feels like the absolute opposite of good accounting.
Well, yeah, it is incredibly dangerous if you do it wrong, which is why examiners love nothing more than watching students confidently record the completely wrong revenue numbers based on a discount the customer hasn't even taken yet.
Just walking right into the trap.
It's their favorite trap to set, without a doubt.
Okay, so let's break this down. There are 3 parts to this. Let's take them one at a time. And to deliver on the promise from earlier, we need to talk about that 5-step rule.
Right, so IFRS 15 provides a comprehensive 5-step approach to recognizing revenue. Step 1 is identifying the contract. Step 2 is identifying the performance obligations.
Okay.
Step 3 is determining the transaction price. Step 4 is allocating that price. And step 5 is recognizing the revenue.
So where do the discounts fit in?
The core of this prompt payment discount issue lives entirely within step 3. Step 3 requires an entity to determine the transaction price. Simply put, It's the amount you actually expect to be entitled to in exchange for transferring those goods or services to the customer.
That makes perfect sense for a normal transaction. I mean, I hand you a shirt, you hand me $20, we're done.
Exactly.
But then we hit part two, which is variable consideration. When you offer a prompt payment discount, that expected consideration isn't a single solid number anymore. It becomes variable consideration because the final amount you receive depends on a choice the customer hasn't made yet.
Yep, it's totally up in the air.
Okay, let's unpack this. If the price is variable and entirely up to the customer, how on earth do you book that on day one without breaking the rules?
And that brings us to part 3, the highly probable limit. IFRS 15 deals with this exact uncertainty by strictly limiting the amount of variable consideration you are allowed to recognize.
Okay.
You can only include that variable amount in your transaction price if, and only to the extent that, it is highly probable that its inclusion will not result in a significant revenue reversal in the future.
A significant revenue reversal, meaning, well, IFRS 15 is actively preventing that earnings management scenario we talked about earlier. You don't want to have to take back revenue you've already claimed because you were too optimistic.
Exactly. You don't want to inflate your books on day one and then scramble to erase that revenue when the uncertainty is subsequently resolved.
Right.
The standard setters use the phrase highly probable very intentionally. It's a really high threshold.
So how do you know what is highly probable?
You figure this out by looking at past customary business practices. You have to use historical evidence of how this specific customer, or a very similar group of customers, has behaved in the past.
So to bring that together, use the customer's past behavior to estimate their future payment, and you book your revenue based on that educated guess from day one.
Precisely. You aren't guessing blindly. You are estimating based on a documented track record. The data drives the journal entry.
Let's make this totally concrete. We have a great scenario from the source material that illustrates exactly how this plays out globally. Let's look at Jayco.
Okay, so Jayco sells goods on credit with a standard 30-day payment period. But they have offered their customer a 3% prompt payment discount if the payment is made within 14 days.
Okay, let's say I'm an early career accountant looking at a $2,000 list price sale. This will be example 1. Based on past experience, I know this specific customer always pays within 14 days. They love the discount. They never miss it. What exactly am I writing down in ledger today?
Because the customer is expected to pay within 14 days based on their past behavior, you anticipate they will take that 3% discount. So you must record the initial sale net of the discount.
Got it.
3% of $2,000 is $60. That means you expect to receive $1,940. Your accounting entry today is to debit trade receivables for $1,940 and credit revenue for $1,940.
Wow, it's fascinating because the physical piece of paper, the invoice, says $2,000, but the ledger says $1,940 right out of the gate.
Yeah, because under IFRS 15, the transaction price is what you expect to be entitled to, not just the ink printed at the top of the invoice.
But what if I'm dealing with a nightmare client, the one who always drags their feet? Let's look at example 2 for our listeners managing more complex portfolios. Imagine it's an $8,000 invoice for a notoriously slow-paying client who never hits the 14-day window.
Oh, we all know those clients.
Right. They always take the full 30 days, sometimes 35.
In this scenario, management judgment dictates you record the full $8,000 immediately.
Oh, immediately.
Yeah, you expect them to miss the discount window based on their customary business practices, so your expected consideration is the full list price. You debit trade receivables for $8,000, and you credit revenue for $8,000.
Oh, okay, that makes sense.
By doing this, you are protecting your gross profit margin estimates from being artificially deflated by a discount, historically won't be used.
But history isn't a crystal ball. What happens when our expectations are wrong? Customers can surprise you.
They definitely can. And the mechanics of IFRS 15 are built to handle exactly that reality. Let's go back to example 1, where we expected the early payment.
Okay, the $2,000 invoice.
Right. We booked the revenue at $1,940. But let's say this time, the customer's accounts payable department is running behind, and they pay after the 14-day settlement period. They missed the deadline.
So they forfeit the discount. They have to pay the full $2,000. Let me map this out so I don't get lost in the numbers. They send us a check for the full $2,000. We debit cash for $2,000 because that's what hit the bank. But our trade receivable sitting on the books is only $1,940.
Which means your journal entry is currently out of balance by $60.
Right.
When that cash arrives, you debit cash for the full $2,000. You need to clear the customer's balance, so you credit trade receivables for the $1,940 you originally recorded. You have $60 extra in cash that needs a home.
So where does it go?
You must credit revenue for that extra $60. You are basically adjusting your revenue upward to reflect what actually happened.
Okay, let's flip it for example 2. Our notoriously slow-paying client. We book the full $8,000 in revenue on day 1 because we assumed they would be late as usual. But miraculously, they get their act together, pay within 14 days, and actually take the discount.
A rare event, but it happens. They only send you $7,760. That's the $8,000, the 3% discount of $240.
Okay.
Let's walk through the ledger. When the cash hits, you debit cash for $7,760. You credit trade receivables for the full $8,000 to wipe out their debt entirely.
Wait, now the entry is out of balance again?
Exactly. Your entry is out of balance on the debit side. To balance it, you must debit, which actively reduces your revenue by $240. You essentially have to reverse that portion of the revenue you claimed on day 1 because your initial estimate was wrong.
And that right there is exactly what the examiner is testing when they ask about adjusting revenue when the uncertainty is subsequently resolved. They want to see if you can fix the ledger when reality contradicts your initial, highly probable estimate.
It is a true test of whether you understand that revenue isn't always a static, immovable number once it's booked. It responds to the resolution of variable consideration.
Which brings us to the biggest pitfall. There is one single mistake that trips people up over and over again on this topic.
Oh, yeah.
It is automatically booking the sale at the discounted price just because a discount was offered, completely ignoring the probability of it being accepted.
It happens constantly in exams and honestly in junior accounting roles too. And if we look at the metacognitive reason, like why our brains actually do this, it makes total sense.
Why is that?
Think about how we're taught math from childhood. When the human brain sees the word discount or percentage sign in a scenario, it immediately wants to execute an operation.
It wants to solve the puzzle.
Exactly. It wants to subtract it. It's a reflex. We are trained to solve the math problem placed in front of us. But the brain forgets that under IFRS 15, it's the past behavior of the customer that triggers the math, not the mere presence of the word discount.
My instinct here, if I see 3% discount, is just to subtract 3% and book it. It's almost a physical reaction. So how do we retrain our brains to catch this before making the mistake?
You have to force a cognitive pause. Simply stop, scan the scenario specifically for the phrase based on past experience, and let that past experience dictate your first accounting entry.
That's good advice.
Yeah, do not touch your calculator until you have verified if the customer's history says they will actually take the discount.
Honestly, booking a discount before checking past behavior is like buying a gym membership and immediately claiming you've lost 10 pounds. You have to look at your actual track record first before you adjust the numbers.
That is a very accurate, if slightly painful way to look at it. You cannot claim the result without the historical evidence to back it up.
We want to make sure you walk away from this deep dive with absolute clarity. 3 things. Here's number 1. Always locate the expected customer behavior first. Before you calculate any percentages, look explicitly for phrases about past experience or customary business practices.
Spot on. Tip number 2, book your initial revenue based strictly on that expectation. If they are expected to take the discount, record the net amount immediately. If they aren't expected to take it, record the full list price.
And tip number 3, prepare for the adjustment. If the customer's actual payment contradicts your initial estimate, you will need to adjust the revenue up or down to fix it when the cash actually clears.
Because prompt payment discounts make the transaction price variable, you must use past experience to estimate the revenue you are highly probable to keep without a reversal.
For those of you stepping into an exam hall soon, if you just follow those 5 steps logically and map out your debits and credits, the math will fall perfectly into place. You don't have to panic when you see a variable price.
And for those of you in practice, out there dealing with actual clients and managing corporate books, this isn't just about passing an assessment. This is exactly how you defend your gross profit margins and revenue recognition in the boardroom. You base your numbers on historical evidence, not optimism.
So, bringing this all the way back to the start, you don't have to just guess customer behavior and risk completely warping your profit margins, because IFRS 15 gives you the exact blueprint.
Estimate the variable consideration based on past experience to avoid significant revenue reversals. That is the entire key to mastering this standard.
Before we go, consider this. As AI gets better at analyzing massive datasets and predicting human behavior with pinpoint accuracy, will these highly probable estimates just become automated algorithms?
Oh, that's a fascinating thought.
Right. And if the software perfectly predicts who will pay early and who will pay late, what does that mean for the accountant's professional judgment? It's something to think about as the industry evolves. We sincerely appreciate you spending your time with us today. If this deep dive helped clear up the muddy waters of variable consideration, please follow the show on Spotify and leave us a review. It helps more than you know. Thank you for listening.